I want us to take a little bit of time to transition to our next group of speakers, and then we can still ask more questions of everyone towards the end. If Sophie, you would like to go ahead and share your slides. Thank you so much to Anu and Autodesk Foundation as well. I wish there was a way we could do a round of applause that didn't feel so awkward. But if people want to like wave their hands or use icons, like I see a couple of people, I want to thank you so much for your presentation and then being vulnerable, honestly, and sharing your investor profile with the world. I think it will be a great way to move the community forward. And if people are interested in seeing the full profiles, they are, we shared the link in the chat and they're on the Project Frame website. Those are iterative and we will continue to update them as there's new information from the investors themselves. And now I'll turn it over for to Sophie to kick off our next segment, which is from 3 specialists in different areas talking about where they see venture capital going and where it should go in order to rapidly mitigate climate change. So Sophie, if you're there, we'd like to give you the opportunity to share your slides.
Awesome. Let's do it. Thanks, folks, for joining. I realize this is a bit of a Zoom marathon. I don't know about you, but I'm seeing a lot of people cleverly off video. So hopefully we can get you to tune back in and have this bit be very discussion oriented. I'm going to keep my slides section short, but as a recovering management consultant and a kind of data geek, I figured let's use visuals here as well. So some of these slides might be familiar to those of you who follow Climate Tech VC or CTVC, which is a humble newsletter and increasingly more of a market intelligence platform on exactly what it says on the label. So the state of climate tech founders and funds, and we track all of the deal activity in this space. So all of the data that we're going to flash up now is technically public, but we've done the kind of grunt work of scrounging for that information and tagging it on the back end over the past 3 years or so that we've been publishing the newsletter. And I'll also say massive credit to, like, this is hardly a one-woman shop. There's about 20 or so of us that work on CTVC, and I'm lucky to get to flash these slides up here today, but credit goes all around. So with no further ado, let's get going. Okay, assuming folks can see my slides. See my slides here. Cool. Let's get into it. CTVC. So we put out a host of different types of content. I'm not going to give you the full rundown here, but namely it's Monday newsletter. So to get your week started off right, what do you need to know, including a list in emoji bullet points of all of the deal activity that's happened that week. Secondly, these insight pieces, which are often quite analytical and or a market overview, kind of an investor style deep dive into different spaces ranging from carbon markets to metals and mining, carbon offsets, et cetera, and then capital stacks. So these are evergreen resources. We're constantly updating this, and these are lists of climate investors, corporate VCs, and accelerators and incubators, namely put out there as a resource to help founders like myself recently avoid wasting time on digging through kind of marketing to gather information on who's actually investing in this space, and rather we use the deals data to identify the folks that are putting in the work. So hopefully that's a useful public resource. But let's get into it. Again, I mentioned the recovering management consultant aspect here, so I love a good Marimekko chart. The way to read this is the rectangle is kind of the area of, in this case, the count of companies that have raised venture capital funding over the past roughly 3 years. And then each column is a different vertical. And I use the word vertical quite explicitly here. So climate, we see very much as a theme and not an industry. However, there are certainly these at least 7 different verticals amongst climate, right? We all know that climate's definitely pretty heterogeneous and ranges in broad scope. So we see food and land use, energy, transportation, industry or industrials, climate management, kind of climate intelligence, built environment, and carbon as being those 7 kind of core differentiable sectors. And then within that, the smaller rectangles are subsectors that we have explicitly identified and tagged. And so in reading this chart, you might consider the fact that over half of the deal activity is made up from just 3 of these major verticals: food, energy, transportation. And you might also consider, interesting, right? Alternative proteins and food. There's a lot of deal count activity happening there. But I've heard so much about CDR in the news. Strange that it's actually such a small overall vertical or count of companies. But the main takeaway really is there's a whole diversity of activity happening. In fact, well over at this point 1,000 shots on goal, or different companies and different founders out there building towards climate solutions. So I'm going to do a quick flip now. So same data set, but instead of looking at the deal count, we're now going to look at the dollars deployed. And so the picture changes, namely the fact that about 80% or so of the dollars deployed into early stage venture capital deals, right? So we cut off when it starts looking like private equity. Obviously, the lines here are shifting in real time, but let's use an anchor of roughly around once we graduate past the Series C stage and start getting into some of these mega deals, like $100 million plus, we stop tracking because it really skews the data and isn't true venture capital. But we're looking at well over 70 billion over the past 2 years of funding alone. We're in December, right? We put out an end of year report, which we've got itchy fingers ready to send this thing out soon. We'll drop it as early as we can in January. And you better believe that that number has increased very significantly over this past kind of bull market year. But this is looking back from June data prior. And main takeaways, I mean, it sticks out like a sore thumb, right? Like what's going on with transportation, like wild that there's so much funding pouring into EV OEMs, or just kind of this auto category, batteries, micromobility, alternative foods still definitely takes up large share. But then funny things start to jump out, like, wow, nuclear. We barely saw that little rectangle on the prior slide in terms of the deal count. Relative to some of these other subsectors. You might also look at the fact that the built environment vertical is very small and has shifted all the way over to the right-hand side, receiving the lowest amount of funding, at least in the way that we categorize stuff here. So food for thought, hopefully helpful framing. I know that we're about to get into some really interesting impact versus activity analysis that John and the team at Drawdown have been doing a phenomenal job pulling together. So perhaps just for more of the kind of benchmarking, what are we talking about, who's active here, we can flip over into a quick flip of who are the investors. And Carrie, feel free to move me along if would rather kind of talk about something else here, but I know folks kind of get excited, and I know there's a lot of investors on this call as well. So, okay, cool. I haven't been cut off yet. Okay,
you have not. You have a few more minutes.
Okay, super. Okay, this slide at a highest level, I'm happy to go into the details of how we did this, but we took a very rough assessment of defining who is a climate investor based off of their deal activity. Separately, in that running list of climate VCs, we've gone through in great detail all of the portfolios and the thesis and interviewed all of the funds on that list. That's really the true source of who I would go to if I were a climate founder looking to engage. But for the sake of being able to run quick analytics here, we're identifying this solid shade series at the bottom of the bars of climate investors as firms that have participated in 5 or more climate deals over this time period. Obviously, that could be biased by the size of fund, et cetera, but just bear with me. I think it's a solid enough metric to run with. And what we really see is, first of all, that there's a greater number of firms, so investment funds, that have participated in at least one food and land deal versus any of the other sectors. And that could be because it's a great place to kind of I don't know, bite off a corner of the sandwich and kind of dip your feet into climate investing. There's lots of crossover from consumer-oriented funds and other spaces here that have climate inklings. But that really doesn't mean that these folks are necessarily raising their hand and branding themselves as climate tech investors, right? Versus if we go all the way to the right-hand side of the chart, that carbon and even that built environment bar, sure, it's a smaller count of firms that are participating. And most importantly, we see that the proportion of climate active investors, so those folks that have done 5 or more deals, is really high. So it's about half of the folks that are participating in those deals are very active in climate versus, less than 20% of those kind of more climate tourists in food and land use. And that's probably healthy because I would counter that those spaces are potentially the most complex technically and have some of the more complicated climate related market dynamics. So I think this is a good sign of climate interest and also the fact that there's a role for specialization. Next one, I would recommend that folks go to our website and check out a piece that we put out recently on the dry powder in the climate tech market, but namely, we've been tracking all of these new announced climate funds. And in fact, that's over 130 that have been announced over the past 18 months. That's nuts. And when I say announced, I mean a publicly announced press release that they have done a final close. And so there's a backlog of at least about 50 or so that we're aware of that are still in market raising. It's a tricky time to be raising, but it's not fair from a data perspective if we don't count everybody similarly. So we're being pretty conservative and only counting these funds if they've done a final close and announced. And then you'll see that we categorize them by AUM or assets under management, and that we did this funky split of trying to see if there was a difference in the environment between 2021 and 2022 in when these new funds were announced. And in fact, we saw almost literally no difference, just an interesting observation of the equal announcements across the AUM over these past 2 years. We'll see what happens going into more of a bear market, but hopefully lots of logos that you guys recognize. And I know there are some folks from these funds on the call as well. Reason this is relevant is for this next slide. So lots of assumptions that go into this. I was purposely trying to be very conservative with this math here, but the TLDR is there's over 130 new climate funds. What does that mean for founders? What does that also mean for the competitive space for those funds that are trying to participate in these deals? We see at least 40 billion of investable dry powder that's dedicated and earmarked for climate that's currently sitting on the hypothetical sidelines, hypothetically in VC's bank accounts, ready to go into climate. And for founders that are concerned about deal pace slowing or funding for climate entirely drying up, I would counter with this slide and say that we're in an unprecedented amount of dry powder that's in the market for early stage climate venture. I can always go into more, but I'm going to cut myself off actually. So let's stop the share and either take questions or hop right on over to John.
Thank you so much, Sophie. We did have one quick question, and what geographies did the slides cover? And then we'll have it over to John, and then we'll have a discussion later.
Yep. Basically California. So I recognize that there's some bias in our data collection. However, happy to go through that methodology in detail. Essentially, a lot of this is sent to us because we've got a bit of a flywheel going at Climate Tech VC right now. We also scrape everything that we haven't caught from sources like PitchBook and Crunchbase and the traditional sources. So consider this comprehensive and more. This is a view, aggregated over the past 3 years, over the past 12 months. This shifted significantly towards other regions like Europe, and like Australia and Latin America, for example. However, I will note that we are almost certainly not correctly accounting for APAC or specifically like Chinese investment, which is a challenge from public reporting and also from a language perspective of being able to scrape this appropriately. So that's the main watch out, but otherwise we feel pretty darn confident that we're catching a majority of this deal activity.
Great. You have more questions, but we're going to save them towards the end. John, if you would be so kind, could you please share?
Yeah, thank you so much for the chance to be here with you today. Looks like this is working. It's really great to follow Sophie and other speakers today to talk about investing in climate solutions, because this is a multi-trillion-dollar problem. And our thesis is, of course, that we need more capital, but also we need smarter capital. We need to know how, not only to deploy as much as we can, but also make sure that when we're deploying capital, we're deploying it to the right places, and that's guided by science. So to do that, we're building something we're calling a drawdown roadmap, which is basically a scientific guide for like where would the capital best go in order to really address the climate crisis in the most scientifically legitimate way. To do that, I just want to walk you through a couple of quick concepts just to ground everybody. I'm sure you've all seen graphs like this before. Basically, this is a graph that shows us how to land at the Paris targets of between 1.5 and 2 degrees of warming. The bottom line is, we're the red dot. The big job here is to dramatically cut greenhouse gas emissions in like now, in the coming decade. We're going down a double diamond hill, if you will, here in cutting emissions. And another job of growing carbon removal up to a gigaton scale sometime by mid-century. And together that will get us towards, net zero. And in this case, net zero happens around 2050. But the bottom line here is the emissions numbers are large and have to be cut now dramatically. Carbon removal is small. It's basically a round-off error on this graph and needs to grow significantly over time. But the key question here is the value of time, because emissions cuts we take, let's say in the 2020s, shown here, avoid this much carbon from happening or going into the atmosphere. But early action is the gift that keeps on giving. This is a point that a lot of VCs seem to miss. Time is the most important variable when it comes to climate change, because climate solutions are cumulative. They're the area under the curve, not the value on the curve, what matters. So early action we take in the 2020s, they keep on giving through the 2030s and 2040s. And basically the emissions cuts we can take this decade in this scenario would actually do a huge amount of the work from preventing future climate change, because it has 30 years within which to work. This is what you might call the time value of carbon. Again, early investments pay off because it's not just gigatons per year, it's gigatons per year times the number of years that you have to work with. That's why early low-tech solutions work the best, because they have a lot of time with which to work. But then we can keep on going and keep cutting emissions again and again, and we can build carbon removal up over time to gigaton scale by mid-century to take out those last very difficult to abate emissions. But when you look at the area under the curve here, basically cutting emissions, it's about 94% of the work in this scenario. And 75% of the work happened from the cuts we did in the first decade that paid off the following 2 decades. So early action in cutting emissions is critical to the problem. Carbon removal is also really important, especially post 2050, but to getting to net zero, because it starts small and builds up, has a lower time value of carbon integral. And so it's about 6% of the work, but still really, really important. Taking all that information and also looking very carefully at where emissions are, we can provide a lot more guidance now about where we need to invest in order to stop climate change, and basically how to allocate capital to where the carbon actually is, which really isn't being done very well right now. So what we have to do is cut emissions dramatically. We can do that directly, and we'd recommend about 87% of the work is cutting emissions directly in these 6 sectors through various combinations of efficiency gains and decarbonization. I'll get into that in a second. Also, an area that a lot of investors seem to miss is there are indirect ways to cut emissions through social interventions, especially, let's say, helping indigenous communities protecting their land so it doesn't get deforested. Then invest in people first, but then invest in carbon later. Or investing in women and girls, education and family planning, which invest in people first, but pays off through demography and later through reduced global emissions. So people first, then climate. The other is climate first, then people. And then we have carbon removal here, which rounds out the other 6%. And that's both nature-based and kind of machine-based carbon removal. And we can double click on this, of course, and get you a lot more detail into kind of what I call the Earth portfolio. This is the carbon portfolio that we need to do to get to net zero. And within it, which Drawdown has done a lot of work, and so others are beginning to do this too, to identify what are currently viable technologies, let alone new ones we could add to this list within each of these sectors. So these are areas that we see as very, very viable today. So you could, implement them now and get that time multiplier out into the future across sectors like electricity, food and ag, transport, and things like this. And of course, we've also been building cost curves of estimates of kind of the net cost, including lifetime savings and new revenues, not just the initial cost McKinsey typically shows, but you can show kind of cost curves and pick off maybe some of the most affordable solutions, but some that are a little riskier, more expensive, maybe in the tail end here too. One of the things that's really fascinating, though, is to compare this kind of Earth portfolio of where the carbon needs to be cut against capital. And Sophie did, I have to update my slides to get the more recent data from hers. But we've done some analysis of looking at estimates of where philanthropic dollars are, which is a lot less than private capital, but it's so important because it can help de-risk a lot of these solutions. And it's usually the first dollar in to a lot of different areas. But finding philanthropic dollars estimated from ClimateWorks data, a lot of that isn't reported, but what we do have reporting for seems to show a pretty good balance of where philanthropic dollars are going against what the atmosphere needs. But it's a little bit light in industry and other emissions, but doing well in electricity, food and ag, and other sectors. This is probably out of date. Should get Sophie's latest data. This is a blend of some of hers and some stuff from Bloomberg, but also different estimates of where venture capital is. Sophie's data is better than this, so listen to hers. But again, showing that both show that transportation is getting a larger share than it probably should if you looked at the atmosphere, at least in current VC kind of funding landscape. So that's kind of, how would we guide the deployment of capital against the carbon in the atmosphere? So, this is Earth's portfolio. What does ours look like? We're also doing an estimate of what the Inflation Reduction Act will invest in to look at, philanthropic dollars, private dollars, and government dollars, and all those different kind of flavors of money, and see how they stack up. The other thing we have to think very hard about, though, is not just allocating our money across sectors, but also across timescales. Again, the time value of carbon is critical. So to those investors and philanthropists in the audience, I would really urge you to think about your portfolio, not just across sectors and technologies and solutions, but also when do they kick in? Because we really need emergency brake solutions right now that start to bend the curve in the atmosphere materially, like today. They can't wait for not only new technologies, that's irrelevant right now. What's relevant is solutions that can actually start affecting CO2 levels immediately, not even waiting for infrastructure. Things like stopping deforestation, stopping methane leaks, stopping black carbon, refrigerants, energy efficiency within existing infrastructure while we're building out new infrastructure that will take a little bit longer. And of course, investing in people and social interventions that lower emissions, investing in nature. Soils and trees do remove carbon, but they take decades to do so. The atmosphere doesn't notice a tree planted today. It notices it over the next 30 years. And of course, new technologies, which could pay off handsomely in the future, but they're going to have a narrower window of time value integration. So we need a different kind of portfolio mix across the timescales the atmosphere notices, not just the sectors. And then finally, I wanted to mention too, another key area for guiding investment is to work across geography, because there are a lot of 80-20 rules out there that we could be investing in. This might be more appropriate for public and philanthropic investment, but for example, recognizing that about 70% of the power plant emissions in North America come from 30% of the power plants. So if you're deploying renewable energy, where do you do it? Well, where the sun is, where the wind is, where the grids are, where the demand is, but also where you can displace the dirtiest power plants. Or for methane, it's even more shocking. 30% of fugitive methane emissions from the energy sector come from less than 1% of the infrastructure and wells. So let's go find that 1%, and we've solved 30% of the problem. This shows up again and again and again in geographies about deforestation, about renewable energy, about transport, the 80-20 rule geographically, and we need to do a lot of big data work here to kind of pinpoint geographic intervention spots. So with that, I'm just going to make the plea again that we need more capital to go to climate technologies and solutions, of course, but we also need it to be smarter capital and align that better with what the atmosphere is telling us. The work we've been doing so far has kind of been building out this roadmap. We're building the publication elements, some videos and report that'll be coming out soon, but we're giving some webinars too. Also, we're building kind of an educational network for philanthropists and investors. They'll be launched early next year, as well as some online tools that will help climate investors and philanthropists kind of do a, choose your own adventure portfolio development tool to check it across sectors, across timescales and geographies, kind of bringing the science better to the table to help guide investments. Happy to talk to you. If everyone wants to reach out, just drop me an email, and I'll just stop here and say thanks and hope we can have a further conversation.
Thank you, John. That was really interesting. And I can't wait to hear more about that tool you all are developing, since that's something we're really interested in learning more and sharing about amongst our frame community. I want to say that in the interest of time, we're actually going to hand it over to Ramana, and then we'll go into Q&A for everyone towards the end. And then, like I said, I'm happy to stay on later if people still want to discuss things. So Ramana, thank you. Perfect. We can see your slides.
Great. So thank you. Thank you very much again for having me. I think my slides and my discussion follow on really nicely from the earlier two ones. I'll just sort of briefly say that I'm, as Kerry mentioned, I'm a professor at Imperial College London, and also the academic lead of the Institute for Deep Tech Entrepreneurship. And so one of the things we've been thinking a lot about is, given the challenges that have been noted, what are some of the frictions that are driving that wedge between where we might want the money to go and where it's actually going, and what can we do from a university standpoint to try to help with that. But I'll just briefly, before going into a little bit of that, I'll talk to you about a few thoughts related to this paper that I put together that Kerry had also shared with the group before. Okay, so the motivation for this is exactly what Sophie and Jonathan had said, which is that if we want to get to net zero by 2050, we need to be driving a lot of innovation. And indeed, if there's work that suggests that half the carbon that needs to be taken out of the atmosphere between now and 2050 may depend on technologies that are not fully currently commercially viable. Okay, so how can we kind of drive that from a venture capital standpoint? So what in my 5 or 7 minutes, I want to kind of just touch three broad things. The first is I want to show you that using patent data and the text from patent data and the citations to patents, which is a different way of coming at the innovation that is being undertaken in the United States. The venture capital backed patenting is extremely impactful. Okay, so it's 6 times more likely to be among the top 1% most cited patents when compared to other patents that are granted to larger companies in the same year and technology class. It's also more likely to cite fundamental science. So to the extent that we believe that these deep tech-oriented innovations are going to be important, venture capital-backed innovations do tend to be much more science-intensive. And yet, as we've seen in the last 2 sessions, VC-backed startups account for a really tiny share of all the volume of net zero patenting. And we've seen this shift away from deep tech in recent years. We had that clean tech 1.0 bubble where there was a lot of activity around energy, solar and biofuels, and we've really seen a shift away from that towards transportation, which has been shown before. And I'll touch very briefly on some of the things that we think are responsible for these frictions and how we're thinking about it. Okay, so these are 6 broad categories of patents that are associated with net zero, and you can see this is just using the words in those in the patent applications of granted patents that are across these different sectors, and showing you what are some of the words that are coming up. And unsurprisingly, we see that the words map to, or maybe not unsurprisingly, I guess thankfully, we see that the words that are coming up are ones that you might expect to see in these different categories. Okay, now I won't have time to show you today, but the top 3 are really ones that depend a lot more on fundamental science. The latter ones tend to be more engineering based and kind of less deep tech, in the sense that there isn't a lot of fundamental stuff that needs to be done. And so as we also begin to think about where the money needs to go, a lot of what's going to happen is that the research in universities is going to be really driving, to the extent that we need new innovations in these areas, we will really need a lot more of that coming out of universities. Some of this is going to be driven through process innovations and engineering. Nothing wrong with that, but just in the context of what we're thinking about, I want you to focus on the top ones as a particularly salient. Okay, so as we look at the impact of patents that are backed by venture capital backed firms, you can see that if you look at the top 10% of patents in the universe of patents in terms of their citations received, VC-backed startups are somewhere between 2 and 3 times more likely to be in the top 10%. And if you look in the top 1% of citations, they're between 4 and 5 times more likely to be in these top percentiles. So they're incredibly impactful relative to mature firms that don't punch even at their weight. And so, that's sort of the good news behind the VC patents, is that they're certainly involved in incredibly influential and innovative patents that are also having an impact on others because they're citing that work. But this kind of just shows you over the past 20 years, where has the citing, the patenting activity happening, and you can see that tiny little blue sliver there. That's venture capital, and similarly, you can see over here that VC-backed innovation kind of rose in the mid 2000s, but then has declined subsequently as we've seen that shift away from deep tech away to more of the transportation. Okay, so what are some of the things that we think are driving this? Ultimately, venture capitalists and all other risk capital will move towards places where there is the ability to create and capture a lot of value, and oftentimes these areas are ones where it's harder to appropriate value. We've talked a little bit about the capital intensity and the time scale of these experimentation cycles. So it's harder to learn, it's more capital intensive to learn if this new technology is going to work, and that makes it less attractive for someone who is going to be putting in a lot of money and requires 50% IRR. There's an element here that I've become increasingly interested in as I've been working more with scientists at Imperial, which has to do with the fact that the early experiments, the scientific experiments that the scientists are conducting are not necessarily geared towards driving value inflection in the eyes of investors. And so we've been thinking a lot about how we can shift the way in which we design their experiments to be more effective in learning what we need to so that they can get more funded. And then there is clearly a human capital challenge in that many of the people who are developing these innovations are either uninterested or unable to really develop that business human capital. And we've been thinking a lot about how we can improve the match between the science and the business so that we can hand over more easily to others. And so the general premise that I think we're going to be working with is that venture capital has incredible promise. The model doesn't always fit what we need to see in terms of financing these deep tech oriented ventures, but with the help of philanthropic money and impact funds and some of the work that we and others are doing inside universities, the goal is to really take these ideas, get them further along the path to being commercially viable, and then hand off to the trillions of dollars that lie in the capital markets. And hopefully, when those are better risk-adjusted projects, they will also shift the nature of where the money is going to be more proportional to where the need is. So I'll stop there. I know we want to have a long discussion, so I don't want to take up too much more time.
Thank you so much, Ramana. I think even though we are a little bit further along than we'd planned, all of it was really interesting. Everything we learned is really interesting. So I thank you all for sharing that. We'll do a quick, like I said, virtual round of applause for everyone. And now we'll sort of transition into a couple of questions. I have one for you all more broadly, and then we have a couple that have come up in the chat. I also wanted to encourage people to use the raise hand function so I can call on you and you can speak to the group directly. First is, I know you touched on this a little bit, Sophie. It's come up in the chat into some messages to me directly, but to our three speakers now, now that we understand that there is probably a recession coming, but there is all of this dry powder, all of this potential, and the imperative to have climate action as soon as possible. How do you foresee this playing out in climate investing? And is there anything you would like to encourage our investors here to work towards? And I'll start with you, Sophie, and then we'll do Ramana and then John, and then I'll open it up.
Sure, happy to kick it off. I mean, TLDR, it's actually a great time to be a climate tech entrepreneur. Despite the scary news in the market, despite crypto falling off a cliff and everything else in the public markets, the stage is kind of set, despite this weird backdrop in large part for climate founders in particular. So we tried to queue up that data on the dry powder, and again, asterisks, like that's purposefully very conservative. I personally anticipate it's almost like double the number that we put out. And there's funds that have closed and are active and are out there, well positioned to support climate founders through their earliest stages of their journey. So we put out a piece on this, and I don't necessarily want to parrot what I've already published, so I'll drop it here in the chat. There you go. So take on, what does a recessionary environment mean for climate founders? Wonder if the rest of the crew wants to jump in here as well.
I guess I'll give a slightly different perspective. And then I can't speak to what's going to happen in the future, but I can tell you what's happened in the past. And in the past, venture capital, particularly early stage venture capital, tends to be highly pro-cyclical. So in fact, even though it's meant to be the patient capital that is taking a long horizon, we see VCs react more than proportion relative to economic cycles. And the rationale for that, in my opinion, is the challenge around financing risk. So no individual investor, despite a lot of the dry powder, has the ability to take any individual company through all the way through to cash flow positive. They depend on other investors to lead the following rounds. And when they depend on other investors to lead the following rounds, they're thinking not just, is this a good investment, but are others going to be thinking that this is a good investment when it's time for this to raise money? And they also know that since everyone else is thinking that way, VCs tend to start holding their dry powder to protect their own companies rather than leading new rounds of financing. And so there is this super cyclical element of it, even though you might not have thought it would be there. I can't speak to whether the dry powder in climate is large enough in this case, whether there is enough of a consensus that we care about this enough that we'll continue investing despite the fact that we're in a down market. But the things to remember are ultimately, if you're driven by returns, the returns are going to be lower because the ability to generate cash is perhaps less and further away. And that's going to drive all the way back to the early stage investors.
Thank you. And John, did you have anything else you wanted to add before we go to the audience?
No, I think they covered it better than I could.
Okay. Thank you.
If I can hop in there with just a couple more bullet points so I don't kind of constantly sound like I'm just selling the dry powder side of this like positive story. I think things to watch out for that keep me up at night: interest rates and what that specifically means for climate, where there tends to be higher need for whatever capital intensity, particularly at the later stages, which intersects in an unfortunate way with the lack of $500 million plus mega rounds that we've seen slow significantly, like 80% fewer of those deals that have happened over the past 12 months. And then, you know, the fact that it's pretty unclear how the Inflation Reduction Act will actually be doled out in practice at a time where hypothetically it's kind of needed more, and folks are starting to like lean on and expect that capital to be flowing, and yet we're a ways away from those pipes opening up and flowing fully. Thank
you. Nawar, do you want to jump in with your question?
Yeah, thank you. And thank you everybody for the great presentations. I do have a quick question maybe for Sophie or Ramana. Do you know to what extent public markets are actually dictating VC funding for climate solutions? Because when I look at the disconnect in 2015, 2016 up to today in terms of funding going toward transportation, this seems to be largely a Tesla effect in the sense that's where the overvaluation is, and that's where VCs are going. So I'm just wondering if there is a relationship you've observed and whether you think this will continue. Thank you.
Sophie, happy for you to go first, or I can jump in. All right. So yes, I think in general, it is absolutely the case that public markets drive a lot of the VC investing, and that's because ultimately that's going to be a key driver of exit. And so as you look to think about, where are those IPO windows going to emerge, and how are they, how will I be priced? The public market cues are going to be very important. And I think it's in that sense, yes, it's unsurprising that you see this, and you have these. With the internet, it was the Netscape moment. You're like, okay, all of a sudden, boom, we have this, IPO and the floodgates open. Or we had the same with biotech. We've had similar things with different frontier technologies. Ultimately, we need someone to make a lot of money in these deep tech areas, and then everyone will start flooding in to try to fund that. And so personally, my view is let's develop some super attractive investment opportunities at the early stage using non-dilutive money so that the cap table is actually really good for the later stage investors. Have them make a ton of money, have everybody see that there's a ton of money to be made, and that will drive further investment into those areas.
Here, and we're going to release in the new year an analysis of kind of what we're calling the cohorts of different climate or clean tech related exits over time. I think there's been a lot published about the clean tech era, but not much that I've seen, at least since. If anyone's seen any great reporting done on that, please pass that over so we can collaborate on it.
Thank you, Sophie. And I want to make sure we get to this last raised hand, and then I'm trying to wrap it up in the chat rather than take up more air from you guys. Girish, I hope I'm saying your name correctly, but would you please present?
Pretty close. I respond to reasonably anything close to my name. And I've had many, many interesting versions of it, from garish to garnish. So it seems like I may be one of the few people online who actually has the scars from Clean Tech 1.0. Just by way of quick introduction, I was the founder and CEO of ABB Technology Ventures, and until March, I was running Total Energy Ventures, and was also instrumental in the creation of OGCI Climate Investments, and was on their board for 5 years, and recently just closed a 2 billion euro hydrogen infrastructure fund, the first hydrogen infrastructure fund. My question really is, with all these large funds being raised, and Sophie did a great job with her charts and showing all the funds being raised, but the majority of the money has gone into large funds, whether it's the TPG, whether it's General Atlantic, whether it's, Breakthrough, whatever. The problem with large funds is they have to write large checks, which means by definition, they're all going to growth stage, later stage companies. And I'm doing a lot of advisory work now, including with OGCI and Siemens Energy Ventures and a whole bunch of these and on boards. And the one thing I'm finding is very few people have an appetite for early stage investing, particularly on the hard tech side, right? So we have this unique situation where everybody wants to eat the fruit, but nobody wants to plant the trees. So the question is, if nobody's planting seeds or plants today, where are the fruits for future coming from? So I'm just throwing this out to the group at large, whether if you want to respond in person or on the chat room, who are the investors, not just the VCs, but who, the VCs have to go and raise money, So you go talk to somebody like a large pension fund and say, oh, we are $1 trillion pension fund, we can't invest 10 million in a fund. But you're an early stage fund, so we can't. So where is this? How are we missing out an important opportunity out here? I'm just curious to see what the group's experience here is.
I'm happy to jump in with our role. So I'm one of the founders of Carbon Equity, and actually precisely for this reason, we start our company. So what we do is we actually help private individuals allocate their capital to where it's needed most. So we build our own funds that as of 100,000 euros, people can get in. And with that, so far, we've raised 50 million for primarily hard tech, deep tech, all focused on climate. So I think at least that's one corner where we're mobilizing people in, let's say, an easier way, and that avoids kind of the challenges of the bigger institutional space in putting their money in there. But it's a big opportunity, but we're still on the early stages.
Excellent. Thank you.
So I guess I could give my take on this, which is that I completely agree with you. The large lots of money, and this is a general thing, which is that in the low interest rate environment there was a massive influx of capital, and it went to a small number of funds that became very large, which then drove where the later stage activity happens drives the early stage activity because of the financing risk that I spoke about. I think. Ultimately, you need to have people who are focused in understanding the technical risk and be able to deliver to them high quality investment opportunities where they can capture value, have a team that really works, and have a technology that is close enough to achieving some kind of validation with the customer so that they're not spending years with their 50% IRRs trying to learn whether this thing is going to work or not. Once that has happened, and they can kind of use their early stage funding to drive towards certain amounts of product market fit, then these later stage companies are able to come in. So we often complain about we have a scale up problem because there isn't any large money coming in. Well, another way of saying the scale up problem is that there's no high quality early stage companies being handed off to them. And we say there's no early stage activity happening. And another way of saying that is all the stuff coming out of universities is just crap and is not worth funding. And so I want to take that point very seriously and say, let's actually play our role in the ecosystem to try to deliver high quality investment opportunities to early stage investors so that then they can take that and deliver it to the late stage guys. And we can start a virtuous cycle of actually high quality investments coming through. And then, as I said, you only need one or two. You saw Nest. Nest was calling itself a clean tech company until the clean tech bubble happened. Then Nest said we're actually a software company, but it doesn't matter. Ultimately, when somebody makes a lot of money, everybody wants to come in and do the same thing. So we need these beacons. Maybe we all need to agree. Here's an area that we think is going to be an area where a lot of people will make a lot of money. Let's focus on trying to first deliver high quality returns in that subsector. And then we can crowd in a lot of capital from others.
Thank you, Ramana. I think that should probably be the topic of one of our future community meetings is where should we decide as a community to drive a lot of that capital? I know we're a little bit over. I'm typically very nitpicky about staying on time. So I wanted to thank all of our speakers, once again, Prime, Frame supporters, and as well as all of you who are on the call.